Morning students, welcome back. So today we'll continue with our discussion, first of all with that intangible assets that we picked up, right? And then we also plan to start with a different topic that is about impairment. So we had some bit of discussion around the impairment, and there was one question around impairment as well, which I marked you to, which I asked you to mark. So that we'll discuss right now, right? So let's move on to the part related to intangible asset. I'll just share this document with you. And quickly, if you can just help me understand, let's do a quick recap. So what did we discuss on intangible assets? How do you define intangible assets? And what is the recognition criteria of intangible asset? Can you just quickly help me understand that part? So one, how do you define intangible asset? And what is the recognition criteria for an intangible asset? Over to you quickly. Yes, who will answer this? How do you define?
Yes, sir.
Yes,
Intangible
very
asset, if it is an identifiable and if it is not monetary
very
asset
good.
and it is without physical substance.
Mhm.
And then if we are held for the production or supply of goods or services, if we are
Very
able
good.
to rent it out or if we are using it for the administrative purposes. These are
Great.
the definitions, sir.
Very good. Now, in terms of its recognition, how do you recognize and measure it?
If we have entities should able to generate the future economic benefit out of it, and
Okay.
if entity should have restrict others from getting economic benefits.
Okay. So when you talk about the capability of the entity to restrict somebody else from getting the economic benefits, what do you call it as? Control.
Control, yes.
Yes. Yeah.
Yes, sir. Yes,
And
sir.
in terms of its recognition criteria,
Huh.
if let's suppose intangible assets are required to be initially recognized.
Huh.
So how do you measure that?
That is, we have to take the cost, we have to take the purchase cost,
Very good.
duties and taxes, which is irrecoverable, we are going to add it, and minus the
Okay.
rebate and discount. And then we are going to take the directly attributable cost.
Very good.
For acquisition.
Very good. Sure. Now, moving further. Okay, everyone. Now, in terms of intangible assets, we discussed there can these can be of two types, kind of. Yeah. Great. I can see this response from Akila as well. Very good. Now, when you talk about those two types, okay, sort of, when we say types means for the purposes of the discussion that we are doing, that's where we are saying those are types. In that case, one is when you go acquire an intangible asset, right? So that could be one of the way to look at it. The other one is when you internally generate the intangible asset, correct? Yeah. So you are internally generating the intangible asset. Now, in this case, when we are talking about internally generated intangible asset, please help me understand if there are any restrictions in relation to intangible assets which are internally generated. That's one. And what is it that we are required to look into in relation to internally generated intangible assets? Who will explain this? Over to you. In relation to internally generated intangible asset. Yes.
Sir, in case of that one, sir, intangible
Yes.
assets, we have to develop the intangible assets. In that
Okay.
case, we will have research and development phase.
Right.
During the research phase, we will incur many expenses that we will record it in the profit and loss because we don't consider it as a we don't capitalize it. But
Okay.
after the research is ended and we got the solution for developing developing the asset,
Yes.
from that time onwards, the developing process, whatever the expenses that we incur, we're going to capitalize it, sir.
Very good. Now, quickly, everyone, when it comes to internally generated intangible asset, is there any restriction of any kind in relation to any of the assets? I can see this
Goodwill,
response from Akhila
goodwill,
again.
sir.
Yes.
Goodwill.
Very good. So goodwill again is restricted to be recognized. You can't recognize internally generated goodwill. Correct?
Yes.
Okay. Now, next part. If you remember, we also talked about amortization. Yes or no?
Yes.
Now, in relation to amortization, what is the accounting requirement? Yes. What is the accounting requirement in relation to amortization? Everyone, what do you do?
Cost we will, that formula, sir. Cost we will minus the residual value and divided by useful life.
Okay.
So we will charge the amortization. It is
Okay.
prospect, prospective basis. We will take, sir.
Great. I can see this response from Sridhar and Virashri also. Very good. So, as you nicely mentioned, that the cost that we have, it's similar to depreciation. Okay. So, but now you use the different terminology. You don't call it as depreciation. You call it by a different name, amortization. Okay. Now, in this case, as we discussed, when we talk about useful life, residual value, all of these are what? These are accounting estimates. So that's why at every reporting date, you are required to reassess that. Yeah. Why? Because if there are any changes required in relation to that, you'll have to do that. Okay. Clear? Yeah. All right. So now this is, I think, briefly about some of the aspects related to intangible assets that we discussed. So what we can do now is we can look into some more questions, okay, before we really move further. So now all of these questions I would suggest you to answer. Okay, you should try to look into that in terms of the solution. Again, these are not big one, small questions, but this will help us in terms of working on the conceptual understanding. Okay, so now let's look at this next question. Question number 2. Company had spent 45 lakhs for publicity and research expenses on one of its new consumer product, which was marketed in the financial year or the accounting year X1, X2, but it proved to be a failure. In this case, what will be the accounting treatment of this 45 lakhs? And why will that be treated the way you will respond? Okay, so I would need this answer with a reason, please. Right? Over to you. In this case, what will be the accounting treatment? And why do you think such an accounting treatment is required to be followed? Over to you. Yes. Quickly.
So this 45 lakh, I will take it on a profit and loss because it is a research expenses and also it is a advertisement publicity. So
Okay.
I will take it as an expenses in profit and loss because it is not also developed. It is failure. So I will take it, sir, to the profit and
Right.
loss.
Very
I will
good.
not capitalize it.
Very good. What about others? Okay. So I can see Akhila is saying this 45
No.
lakhs, this entire amount is research. Sridhar says it's going to P&L due to because there are no economic benefits and this is in the nature of research. Okay. What about others? Quickly, everyone, what will be the accounting treatment in this case? How do you account for this? Quickly, everyone, a simple one. What will be the accounting treatment? Great. Virashri says 45 lakhs will go to P&L because it is incurred during the research fees. Great. Now, I think this is a quite straightforward question. So when you talk about research, so any expenditure as per the requirements of AS 26, which is incurred in relation to research fees, where do you take it? P&L. So that's first part to it. Next, see, if there is anything which has been incurred by the company in
Yes, sir.
relation to
It will go
advertisement
into
or
P&L.
marketing.
Are we hearing, sir?
Yes, anyone? Any questions on this? I would request you to please stay on mute. Okay, now if there is anything related to advertisement, marketing, promotion, in this case, can we say that such an expenditure is directly attributable to development of the product? Answer is no. Why? Because such an expenditure is definitely attributable to the product. There is no doubt about it. But that is not attributable to development of the product. That is in relation to marketing of the product. Okay, so two things are different. When you develop a product and when you market it, these are two different set of activities. So that's why anything which you have in relation to advertisement, promotion, marketing, where do you take it? It will go to P&L. You will not be able to capitalize this always. Correct? And in such a case, you don't need to get into this assessment of research or development. Okay? So very simply, every time you see marketing, advertisement, promotion, take it to P&L. Right? Next, let's look at this one. A company with a turnover of rupees 50 crores and annual advertising budget of 2 crore had taken up marketing of a new product. Now, in this case, please understand, we are talking about budget. Budget is not accounted for. Okay, so whenever you see this information, so this is only for the purposes of understanding, not for the purposes of accounting. It was estimated that the company would have a turnover of 25 crore from the new product. Okay, so the new product which they come up with, that will generate this revenue of 25 crore, and that's the expectation. Company had debited to its P&L total expenditure of 2 crore incurred on extensive special initial advertisement campaign for the new product. Now in this case, before we get on to the accounting requirement, let's try to understand the thought process here and why there is so much focus on this particular expenditure of advertisement. See, many a times we see a concern. What is the concern? Let's say company has incurred a significant expenditure on advertisement, on promotion, on marketing. Now, why is that done? That is done so that the product which will be launched, that will generate some future economic benefits. And of course, through marketing, the company will be able to generate that. Yes or no? So in such a case, a concern arises that what do you do with this? Because it's such a huge amount. So do you take it to P&L straight away? Or there is some other way to deal with that? Okay, so with that thought process, you can see this entire scenario has been explained. And that's why there is this stress on this expenditure of 2 crore, right? So in this case, what do you think should be the accounting treatment? Over to you. What should be the accounting treatment? How should this be accounted for? Please don't look at the solution. Try to attempt this on your own. Yes, quickly. What will be the accounting treatment? Yes. What will be the accounting treatment in this case and why? Over to you. What do you think? How should this be accounted for? Okay, so then Lakshmi is saying the accounting treatment which the company has followed, means to take it to P&L, is correct. Okay, what about others? So why do you think it's correct? Please also give the reason. Sridhar is saying the treatment seems to be correct. Why? Because it's in the nature of advertisement. Very good. Anyone else? What do you think? What should be the accounting treatment? Why do you think it's appropriate? Quickly, anyone else? What do you do? Then Lakshmi says, I assume because it happened after development. No, it's not necessary. Okay, so many a times maybe the company is doing a marketing while the development is going on. So it's not necessary that you will see this marketing taking place after the product is developed. Okay, during the course of development, generally the marketing starts. Kila says it should go to P&L. Okay, Virashri says, I think the accounting treatment is correct because it's advertisement. Very good. So now in this case, see, every time you see this stress, okay, means if there is anything which is stressed upon, you should not get confused with that. If let's suppose the amount involved is quite significant, again, you should not get confused. You should not bother. What is the accounting treatment for the marketing that we have discussed? P&L. Now, does it matter that the amount is high or low? Answer is no. Okay. So to say that the amount is significant doesn't matter. Any expenditure on advertisement and promotional activities has to go to P&L as per the requirements of AS 26. In the given case, if let's suppose the amount is significant, 2 crore, can the company follow any other accounting approach? Answer is no. That's not permissible. Okay. So what is the accounting treatment they will have to follow to take it to P&L only? Right? Clear? Everyone clear? Any questions? Any questions? Any doubts so far? Any questions? Let me just pick up some more questions before we move further. Okay, so I'll just try to look into something more. Yeah, everyone clear? Okay, sure. So let's look at this next one. Now we are looking at one scenario based question. Okay. Swift Limited acquired a patent at a cost of 80 lakhs for a period of 5 years. And the product life cycle is also 5 years. The company capitalized the cost and started amortizing the asset at rupees 10 lakh per annum. The company had amortized the patent at 10 lakh per annum in the first 2 years on the basis of economic benefits derived from the product manufactured under the patent. After 2 years, it was found that the product life cycle may continue for another 5 years. Means what is the total life in respect of this intangible asset sort of that you can just think of? Then it becomes 7, right? Patent was renewable and Swift Limited got it renewed after the expiry of 5 years. Now, please understand, initially when the patent was acquired, this was done for 5 years. Yes or no? So now, when the product life cycle for which this patent is used happens to be more than 5. So what do they need? They will need this for a period beyond 5 years. So that's why what has the company done? The company has got this renewed. So now you can say after 5 years, company is getting another 5 years, right? The net cash flows from the product during these 5 years were expected to be 36 lakhs, 46 lakhs, 44 lakhs, 40 lakhs, and 34 lakhs. You are required to compute amortization cost of the patent for each of the years. Over to you, quickly. If you can just solve this, help me with your answer. Yes. If you can just solve this and help me with your answer. Over to you. Please try to solve this on your own. Please don't look at the solution. So I'll just wait for maybe a minute or two before I get on to the solution. Okay.
Excuse me, sir.
Yes.
Sir, kindly send me a WhatsApp link, please.
WhatsApp link.
Yes.
I would request IT to send that, huh?
Okay, sir.
Okay. Maybe you can just ping IT. They will be able to help you on this point, huh? Just ping them, huh?
Okay, sir.
All right. Anyone who has solved this? Can start sharing your answers once you're through. Okay. Once you're through, you can start sharing the answers. Okay, very good. The Lakshmi is saying first year it's 6 lakhs. Okay, what about the other years? Yes. I'm just hoping you are onto this. Okay, Akhila is getting the same answer. 6 lakhs in first year. Okay. What about others? Then Lakshmi is getting 6 lakhs in second year as well. All right. What about others? Okay, then Lakshmi is getting 6 lakhs in the third year as well. All right. What about others? Everyone, please start sharing the answer now. What are you getting? Okay, Akila is getting 6 lakhs for second year. Good. What about others? And what about other years? Quickly. Okay, so fourth year, Dhanlakshmi is through. She's getting 6 lakhs once again. Nikhila is getting third year 85,714. Is it? Okay. What about others? Okay, then Lakshmi has computed fifth year, it's 6 lakhs. What about others? Quickly, huh? Two persons are responding. What about others? Where are you? Quickly get on to this. What is the amount of amortization? In this case, you need to compute the amount of amortization. Nupur, please hold on to this for a while. I would request you to please concentrate on the topic. Maybe towards the end of the session, just help me with this point again. I'll just get this sorted out. Okay. For the time being, please concentrate on this. Otherwise, you'll lose out. Huh? Okay. Just try to solve this. Okay, great. Sridhar is saying first and second year 10 lakhs. Ankita is saying 10.8 first year, 13.8, then you get 13.2, 12 and 10.2. Okay, no, Nupur, if you can just also compute this quickly and share your answer. What about others? Anyone else? Anyone else? Quickly, huh? Okay, so now what I'll do is I'll just move on to the solution, right? So now let's look at this. See, Swift Limited, if you remember the fact pattern, otherwise you can also open the study material alongside. Amortized 10 lakhs per annum for the first 2 years, right? So this becomes 20 lakhs. The remaining carrying cost can be amortized during the next 5 years because all in all, what is the product life cycle over which they will amortize? 7. So 2 is done. What is the remaining period for which we need to sort of compute? Remaining 5. All in all, it's 7. Okay. And that is what you'll do on the basis of net cash flows arising from the sale of the product. Right? Now, in this case, 20 is already done out of 80. So what are you left with? 60 lakhs. See, what is the total cost? 80. 20 you have amortized. So what is the remaining cost that you have? 60. Now 60 you need to amortize over the remaining 5 years. But do you amortize it over the period? Means do you equalize that? No. You will do that on the basis of net cash flows, and that information is given to you in the question itself. See, the good part is in the question, the methodology you are required to follow, the question is telling you. So in a way, this answer or how to solve this is already given in the question itself. So what are you required to do? You are only required to do the calculation. Correct? So if you amortize this 60 on the basis of the ratio, what? 36 over which you will amortize 60. So what do you get? 10.8, 13.8, 13.2, 12 and 10.2. Yes or no? Right? Simple calculation. Correct? The only thing which you need to remember in this question is that you will not be equalizing this over the period. Right? You will be charging the amortization on the basis of the net cash flows. Correct? Everyone clear? So you can just check your answers. Maybe some of you would have got this answer if you are able to compute this. Or if you are not able to compute this, or if your answer was different. So I think you'll understand where did you differ. Right? Any questions on this? Sridhar is asking how to calculate the ratio. So the ratio is very simple on the basis of the cash flows. So you can take the total. let me just quickly take the total. So if you take this 36, 46, add this Sridhar, okay, then you take 40, then you take 34, right? So now 60 lakhs you need to apportion in that ratio. Okay, so if you do that, so if you take the total, Akhila is saying this comes out to 200. See, either you can take the absolute amount or you can just remove the lakhs portion, whichever way you feel comfortable. Now, in this case, you will get 200. So divide 60 lakhs by 200. Multiply that with 36. Or let me just try to solve this. Just give me a minute. So if you want, I'll just quickly solve this. Just give me a minute. Okay, so what I'll do is I'll just take you to a working file. So if you want, we can look at this calculation as well. Okay, so now we have this. $80 lakhs was the total cost. First year, 10 lakhs amortized. What are you left with? 70 lakhs. Second year, again 10 lakhs was amortized. What are you left with? 60 lakhs. Correct? Yeah. Now, in this case, for this 60, what did you do? You will take the total of all of those amounts. 36 plus 46. So I'll just do this rough calculation for you. So you will take 36 plus 46 plus 44, 40, 34. So if you add this, what do you get? 200. Right? Now you will allocate in this ratio for third year, fourth year, fifth year, sixth year, and the seventh year. So for the third year, how do you calculate? You will say 60 lakhs divided by 200 multiply with 36. So if you do this, can you tell me what is the amount you will get? Tell me what is the amount you will get? Quickly, Sridhar, you can just tell me the amount you will get. Akhila has shared this, but I'm just waiting for Sridhar to calculate. Then Lakshmi, Akhila, 10.8, right? So that's how you will be calculating for each year. Okay, so in this case, in the third year, 10.8 will be the amount of amortization. Similarly, you will calculate it for fourth year, fifth year, sixth year, seventh. Got it? Sridhar, got it now? Yes, quickly please confirm. Yeah, got it? Very good. All right. Anyone else? Yes.
Good morning, sir.
Good morning.
Sir, as these cash flows are just expected cash flows, right?
Right.
As a real cash flows might vary. Why we are not? Do we need to change the spread out if the real cash flows vary?
See, the point is that we will be able to calculate on the basis of information given in the question. Yes or no? Now, in the question,
Yeah, sir.
are we given two types of cash flows, expected and real one?
No, sir, but I'm just asking you basing on a practical scenario. I'm just
See, on the
asking
basis
you
of
the practical scenario. Like,
right. So let's look at this. On the basis of the practical scenario, what will happen? You will have some expectations each year, right? So at the end of second year, what will the
yes,
company do? Company will build an expectation. Okay. And on the basis of expectation, what will they say? That we will amortize it on the basis of the expected net cash flows. So at the end of third year, what do they do? Let's suppose 36 turns out to 40. So they will replace this 36 with 40, and the remaining amounts will remain expected, because on day on year 3 you don't know what are going to be the cash flows in the next 5 years. So each year amortization is required. So the year's number which is through will be actual, but the remaining will always be estimated.
okay,
Understood?
sir.
Yeah.
Yeah, sir, got it.
So in a
Yeah.
way, every year company
Thank you,
will
sir.
move up the expectation.
Keep on reviewing the cash flows, right? Expected cash
Yes.
flows.
The same thing will be done for
Okay, sir.
life also, isn't it? So each year company
Okay,
is
sir.
reviewing the life. So let's suppose company is saying at the end of first year life is 7. At the end of second year again they will have to say it's 7. At the end of third year they may say no, it's not 7, it's 6. So what do? They keep revising that. So same thing will happen in case of
Okay, sir.
cash flows. Or let's suppose if the company is charging amortization on the basis of number of units produced, same thing will happen over there. Okay.
Sir, one more thing, like
Yes.
on what basis, like as you said, we can also take number of units and everything. Not many factors for for amortization, method
See,
of
that is up
amortization.
to the
Like
company.
who will decide?
It's the management who has to decide. Of course, with the
Okay.
help of technical teams. So that's how it works practically. Okay, so they decide what is the best way for them to amortize it. Means, see, when you take the period you can say is a very generic approach. When you don't know any methodology, means if you can't assess that specifically in terms of this amortization, what do? That's when you follow a generic approach. What is your generic approach? Let's take the period and equalize this. Equalization is the last option you will follow. But generally, that last option is followed because the other options are not available, or those are not
Okay,
clear
fine.
to the company. Okay?
Okay. Okay. Okay, sir. Thank you so much, sir.
Sure. Anyone else? Any more questions on this? Akila is asking, for example, expected net cash flow 46, but actual 40, then different 60. No, it's not about difference 60. It's about revising your base. See, when you are amortizing it, okay, in the example we took, what was the base? 200. Yes or no? That's the total we computed. That the base was 200. If let's suppose next year your numbers change, your base may become 180, your base may become 220. So your base will keep getting changed. If at all there is a change, you'll have to reassess the base in a way. Clear? Clear on this now? Very good. Anyone else? Any more questions on this? Any questions? Any doubts if you have? No? Everyone clear? Great. So let's look at this next one up.
Sir,
Yes.
under amortization ratio in textbook,
Yes.
in the material it shows 0.180,
Mm-hmm.
but we got 10.8, sir.
So what they have done is on the basis of 10.8 means what? What are you saying? 10.8?
Amortization, that ratio,
Uh-huh.
when we calculated 60 by 200 into 36, we got 10.8. But
Right.
here they got 0.180.
See, what they have done is when you are calculating 60 by 200, you are considering the period from 3rd year to 7th year. Yes or no?
Yes, sir.
For your purposes, what they have done is they have given you the amortization ratio for all the 7 years. So if let's suppose you take it on a scale of 1 for all the 7 years, you compute the amount. Let's suppose you have computed for all the 7 years. And if you, let's suppose, put it on a scale of 1 for all the 7 years. So that's when they are saying it comes out to 0.18. Why? Because in the first year, in the second year, your net cash flows were 0. Okay, understood? So when you are looking at 0.18, so this 0.18 is only an indicative thing. This is just for your reference that if you, let's suppose you take all the 7 years. So what did you charge in first year? What did you charge in second year? So that is effectively 0.125. Clear?
Sir, how will the 0.125 is come, sir, for year 1 and 2?
So you take this ratio. What is your amortization amount in first year?
10 lakhs.
Divide that with total amortization amount.
0.125. Yes, sir.
Understood? That's how you will get.
Yes, sir.
Clear?
Okay, sir. Yes, sir.
All right. Anyone else? Any more questions if you have? No. So let's look at this. During X1, X2, an entity incurred costs to develop and produce a routine low-risk computer software product as follows. Completion of detailed program and the design phase 1, 50,000. Coding and testing phase 2, 40,000. Other coding tests phase 3 and 4, 63,000. Testing cost, again, this was in phase 3 and 4, 18,000. Product masters for training material, phase 5, 19,500. Packing the products, so 1,500 units, phase 6. Okay, so that's the information which is available to you. Amount is given in each of the phases. This is to develop and produce the product. Okay. After completion of phase 2, it was established that the product is technically feasible for the market. You are required to comment on the accounting treatment of each of these costs. Over to you. Yes. What will be the accounting treatment for each of these costs? Tell me quickly. Over to you. I think it's a very simple one. Quickly. Who will answer this? If you want, you can speak up. If you want, you can just write your answer. So there you are. I've got this answer. Very good. So now, then Lakshmi says 1,17,000 goes to P&L and 90,000 goes to capital. Okay. Akila says it goes, I'm assuming entire amount goes to capital. Sorry, capitalized. Huh? Is it? Okay. What about others? I would request you to please give the reason alongside. So when you say this is capitalized, this is getting to P&L, what is the reason? What is the basis for you to say that? Okay, that's very important. Yes, quickly. What about others? What is the accounting requirement in relation to each of these costs?
So for what I think is, like after
Yes,
phase two, the product is ready to be sold. Is ready for the market to be
right.
sold. So I took it 90,000, which is to be capitalized. After that, it is since it is ready, whatever expenses it is done, I've taken it as to be going to the profit and loss.
Okay. So that's the basis you have considered, huh?
Yes, sir.
Okay, good. So now if we look at this response from Virashri says cost incurred phase 1, phase 2 goes to P&L because it's the research phase. Akila says, no sir, the entire amount we need to capitalize. Okay. Sridhar says 90,000 you will capitalize. Why? Because it's the establishment of the product. Okay, very different reasons from each of you. What about others? Quickly, what do you do and why do you follow that? Quickly, everyone,
So
try to
11
answer
question we will
this.
not discuss, sir.
Sorry,
Sir,
11 question we will not discuss.
sorry.
TYK 11th question we will not discuss, sir.
I would request you to please concentrate on what we are doing, isn't it?
Okay.
And
Yes,
once
sir.
we are through, that's when we can decide what to do, what not to do, huh? Please, for the time being, concentrate on this and try to answer this.
sir, can you able to
Yes.
hear me?
Yeah, I can hear you.
Sir, 1,17,000 to be capitalized because the phase 2 is completed, research phase, and the feasibility for the market, technically it is feasible, hence it is
So how do
capitalized
you get
with
1,17,000? First of all, if you can just tell me.
3, 4, and 5, 6.
Okay, 3, 4, 5, 6. These are the
Yes.
phases you will capitalize.
Yeah.
Okay. And what about phase 1 and 2?
Phase 1 and 2 should go to the P&L because it
That
is a
should go
research.
to P&L. Okay. What about others? Tell me quickly. Pawan says phase 3 to 5 we capitalize. Reason is missing. Regan says, sir, I think entire amount means all of these phases, you take it to P&L. Okay, sure. So I think we can now look at the solution, correct? So now if you move on to the solution, so let me just quickly take you to that. In this case, cost incurred in creating a computer software. Just a minute, I can see this response from Anil as well. Okay, fine. Cost incurred in creating this software should be charged to research and development. Means that's how you will decide every time because you are developing an intangible asset. So what is the research phase? What is the development phase? Fine. Technological feasibility or the asset recognition criteria. I think the question specifies when is that established. Correct? These have been established upon the completion of detailed program design, coding and testing. So that's why up to phase 1 and 2, it's quite clearly given in the question. Technical feasibility was not established. Yes or no? Yes or no? Technical feasibility was not established. So that's why, will you be able to capitalize that? Answer is no. You can't do that. Correct? So where do you take it? It goes to P&L. Now, the cost incurred from the point of technological feasibility, which has been established, until the time product costs are incurred are capitalized. So if you look at phase 3, 4, 5, clearly. But if let's suppose the product is now developed, it's ready for use. after that, if let's suppose you are incurring some cost on its packing, will it be appropriate to call it as the product cost of, see, what we are discussing here is any cost to develop the product. Do you think packing cost is required to be incurred for the development of the product? Tell me, will it be appropriate to say that packing is required for the development of the product? You may be thinking, but sir, we will not be able to sell that, which is fine. Are we looking at the inventory right now? Answer is no. What are we looking at? We are looking at the cost which is incurred, which is directly attributable in relation to development of the intangible asset. So that's why in this case, packing cost again cannot be capitalized. Where do you take it? This again will be taken to P&L. Okay, this will be taken to P&L. Clear on this? Yeah, everyone? I can see this response from Kambira Kajnam. So he's saying, I just missed his response. So I think he was also talking about the same point. Great. Right? Any questions on this? Any doubts if you have on this? Before we move further, any questions, any doubts if you have on this? Any questions, any doubts? No? Sure? Okay, Kambira Kajnara is asking, sir, market feasibility means market also, see, market feasibility means it's viable. Means let's suppose you develop the product. Why do you develop the product? Eventually you will plan to generate the economic benefits. If let's suppose you are not able to do that, what do you do? Is there any point in developing that? Okay, so that's why you don't only check the technical feasibility, you will also check the financial viability, right? Pavan is asking, sir, can you please explain phase 1 and phase 2? I mean the expenditure. Yes, sure. So if you go back to the question, I think you need to look at the fact pattern which is given in the question itself. See, the question says, if you read this sentence, after the completion of phase 2, it was established product is technically feasible. What does it mean? Pavan, it means up to phase 2, research was going on. Why? Because till the time technical feasibility is not there. You are trying to establish that. What do you call it as? That's the research, isn't it? Yeah. So any cost that you incur during the research phase, what do you do with that? P&L. You charge it off, right? So the same thing we have done here. Now clear? Right? Pavan, clear on this now? All right. Any questions, any doubts if you have on this? Then we'll move on to the next one.
Sir, in the solution, am I audible,
Yes.
sir?
Yes.
Yes, sir. In the solution, they're giving coding and testing and packing the products. These are all expenses. But my doubt is other coding costs, testing costs, product master for training materials. These also expenses, sir, for completing the products.
So how do you So what makes you say that these are expenses or these are not the expenses? So if you are thinking in that direction, can you tell me the thought process? Why do you think about it? What is the basis for you to say that?
Because the question is given other coding costs, so it will be used for coding the cost, coding the expenses of coding.
Okay, very good. So actually what you are trying to do is you are trying to look at the nature of the expense. Yes or no?
Yes, sir.
And on the basis of the nature of the expense, you are trying to establish that. Correct?
Yes, sir.
So now this is your phase 1, this is your phase 2, this is your phase 3, 4, 5, 6. Let us just say that a similar expenditure, okay, let me just say what is the nature of the expense? Coding is incurred in all the 6 phases. Same expenditure. Okay. And we are made to understand that on this date, when you end this year 2, that's when your research phase gets over. Okay.
Okay, sir.
Say up to this year end 2 or up to this phase 2, you can call it as year or phase for the purposes of our understanding. And the moment your phase 2 got completed, that's when you entered the development phase. So in this case, what should you do? Will you be worrying about the nature of the expense? Of course, you may do that. Huh? So your concern is valid. I agree with you. But the point is that in terms of the coding, what was done up to phase 2 with the coding expense being incurred, we didn't know as to what has happened. Maybe the final click that we had worked for the company, because in the research phase, what are we doing? We are doing the experiments. You don't know when the experiment will work, and you finally get the formula. Do you know that? No. So it's a trial and error method. You're just trying to sort of invent something. You're trying to come up with something new. Yes or no? That's what you call as
Yes.
research. Now, we are given to understand that at the end of phase 2, your research is completed. So that's why, should you be worrying about the nature of the expense? Answer is no.
Okay.
Right? Clear on this now?
Yes, sir.
Okay.
Yes, sir, clear.
So of course, I've just tried to give you 2 perspectives. One, how do you need to look at it in terms of answering the question in the exam? Second, even if you say that forget the exam, I want to understand it conceptually, practically. So I've given you that perspective as well. Okay, that you don't know. Maybe the similar sort of expenditure was incurred, but now it has worked. So it clicked. So that's why you're saying my technical feasibility is established. Okay, so from here on, any expenditure that I incur, maybe of similar nature also, I'll capitalize. Before that, I'm not permitted to capitalize. Okay.
Yes, sir. For that's why the question is given to avoid that confusion. After completion of phase 2, it was established that the product is technically feasible for the market.
See, the
That
question will
line will be
always
put.
have to tell that. Please understand the
Yes.
problem
Yes, sir.
of the examiner. Unfortunately, examiner doesn't have a choice but to tell you. Otherwise,
Yes.
how will you get to know about it? On the basis of the nature of the expense, you may not be able to establish this. Correct? Yeah.
Yes, sir.
So unfortunately, the examiner doesn't have a choice, and that's the best part for you. So in a way, what do you find? The answer is given in the question itself. The only
Yes,
thing
sir.
you are required to do is what? Calculations. So if you
Yes, sir.
look
To
at some of
split
these
what is the
questions,
expense.
in all of
Yes, sir.
these questions, answer is given in the question itself. It's only the arithmetical exercise you are required to do. Yes or no? So if you go back to the questions, you revisit that, the same thing you will find. Yes or no?
Yes, sir. Yes, sir.
Sure. Anyone else? Any more questions on this? Any questions? Any doubts if you have? No? Okay, so I think we can look at one more. So let's look at this next one. As per the provisions of AS 26, how would you deal with the following situations? So how many situations do we have? 4. Okay. So I'll just read out all the 4 and then we can just discuss this one by one. Okay. Rupees 23 lakhs paid by manufacturing company to the legal advisor for defending the patent of a product currently treated as capital expenditure by the entity. Next, during the year X1, X2, companies spent 7 lakh for the publicity and the research expenses on one of its new consumer product, which was marketed in the same accounting year, but proved to be a failure. Okay. A company spent rupees 25 lakhs in the past 3 years to develop a product. These expenses were charged to P&L since they did not meet the criteria of capitalization as per AS 26. In the current year, approval of concerned authority has been received. Company wishes to capitalize 25 lakh by considering it as a prior period item. Fourth, company with a turnover of 200 crore and this annual marketing budget of 50 crore had taken up marketing of a new product by the company. Its estimated company would have a turnover of 20 crore and the company debited to its P&L expenditure of 50 lakh on extensive special initial advertisement campaign for the new product. Okay, so for each of these, we need to look at the accounting treatment. Over to you. What do you think? What will be the accounting treatment? Yes, so you can just look at each of these. I think 4-1 seems to be the one, sorry, 4th one is sort of duplication. We have already covered that. So maybe if you want to answer 4th one, you can do that. You can ignore that. I'm completely okay with that. So what about first 3? Over to you. What do you do? What should be the accounting treatment? For the first one, for the second one, for the third one. Surinder says first should go to P&L, means the accounting treatment followed by the company is incorrect. Is it? Okay. What about others? And what about second and third, Surinder? Yes, quickly. Sridhar says first one goes to P&L. Akhila is saying legal advisor cost goes to P&L. Surinder says second one should also go to P&L. Okay. So I think it will be helpful if you can just also give the reason alongside, right? Then Lakshmi says first and second should go to P&L. What's the reason? It will be helpful if you can also give the reason alongside. Sridhar says second one should go to P&L because it's in the nature of research expense, means it's the research fees. Okay. What about others? Then Lakshmi says legal expense, first one. Second one is research, so that's why it goes to P&L. Okay. Pawan says second one goes to P&L. Akila says second one P&L because it's research. Virashri says second one 7 lakh goes to P&L because it's research and publicity. All right. Now let's talk about the third one also, please. I think third one nobody has discussed. What do you do with the third one? What should be the accounting treatment for the third one? Over to you. What will be the accounting treatment for the third one? So in this says company can do that and capitalize 25 lakh because of the company developing the product. Then Lakshmi says third one does not meet the criteria of AS26, means the capitalization seems to be the case, and that's why it's something you'll take to P&L. Virashri says yes, the capitalization can be done for the third one. Okay. Sridhar says third one will also go to P&L because it doesn't meet the capitalization criteria. All right. What about others? Then Lakshmi says fourth one goes to P&L. No, so fourth one I think is clear, sort of, right? So I think we can now move on to the solution. Correct? So let's look at all of these one by one. Akila says 25 lakhs capitalized for the current year, not for the past year. See, that's for the past years only. Current year, you don't have the amount. Okay, so this amount which is given in the question, if you look at the question carefully, it's for the past years only. For the current year, there's no other amount incurred. So you don't have the amount incurred in the past years and in the current year. Okay. Sridhar says fourth one also. No, fine. Fourth one is fine. So let's move on to the solution now. Pawan says third one goes to P&L because it doesn't meet the capitalization criteria. All right, great. So let's look at all of these one by one, right? Now, if you look at the first one, legal expenses which are given or which are incurred to defend the patent of a product. What do you do with that? Has it got anything in relation to development of the product? No. There's nothing around the development of the product. So should this be capitalized? Answer is no. Clearly, right? I think second one is straightforward. Why? Because second one we understand it's in relation to the advertisement, promotional. Third one. If let's suppose there's an expenditure which has been incurred. Okay. Now, let's suppose instead of capitalizing, company took it to P&L. Why? Because company thought it's related to the research phase. So the standard says any amount which has been taken to P&L, you can't recoup. Means you can't bring it back from P&L and capitalize. That's not permitted by the standard. So in this case, if the company is trying to do that, is it permissible? Answer is no. Right? So that's why in this case, once it's gone to P&L, will stay in P&L. You can't bring it back. So that's why you will not be able to capitalize it. Understood? Clear on this? Regan is asking, sir, in the third one, I couldn't understand the meaning of this sentence, approval of the authority. So you can say maybe as a process in relation to the project which they were into, some approvals were required from a particular authority. Until the time those approvals were not obtained, company was charging to P&L. After that, they thought that now we will capitalize. So you don't know the exact fact pattern, and we don't need to understand that as well. Important point is what? Something which goes to P&L, you can't recoup. Standard isn't permitted. So that's the point over here. Clear? Veerashri says, but 25 lakh is incurred for the development of the product. Exactly. But the problem is, if it was incurred in relation to the development of the product, why was it not taken to the development cost? Means, why was it not capitalized as development cost the way it should have been? Why was it charged to P&L? So that's where the standard says that something which you take to P&L once, you can't recoup. Okay, that's what the standard has clarified. So that's why you can't do that now. Once it's gone to P&L, it will stay there. Right? Anyone else? Any more questions? If you have on
Sir,
this?
could you
Yes.
please tell me what's the reason behind that restriction by this standard?
See, the reason is very simple. If let's suppose company changes the thought. Initially, when the company was not capitalizing that, there must have been some thought. Yes or no? Subsequently, company cannot
Yes, sir.
the hindsight and say that no, this was not the appropriate thought. Otherwise, what will happen? Unnecessarily, there will be manipulation in the books of accounts. So that's why you have this accounting treatment. Okay.
Sir, but what if management is in dilemma? Can they keep on hold like without capitalizing or without
So what do
posting
they
in a
do?
P&L?
Let's suppose company is in a dilemma. What do you want the company to do? For 3 years, they will not do the accounting. Tell me, is it practically possible?
Do they have that option, sir? Like,
You tell
is
me
that
a
possible?
practical.
Do they have
So
that
you
option?
tell me, is that
No, not at
practically
all
possible?
possible, sir.
Yeah. So
No,
why?
sir, not at
Think
all.
about it. If let's suppose company has spent 25 lakhs, you are thinking that let's put it on hold. So what do you mean? That for 3 years company should not do the accounting, is it? Can that be an option available to a company? Let's think about it logically.
No,
Is it?
sir, not at all.
Answer is no. Understood?
No, sir,
So
not
what
at
you
all.
are thinking is
Sir,
hypothetical.
one more thing.
Yes.
Sir, one more thing. Like,
Yes.
who will be judging these aspects? Like, will experts be involved or just management on its own?
See, it's the management and the technical team. So that's how they decide this. Okay, so they get into a discussion, they assess this on the basis of their discussion, deliberations that they have. This is finalized.
Sir, if it is management on its own, then there will be lot many loops in accounting, right? Like books of accounts.
Why?
They'll do like they keep on changing the phases and keep on posting expense in P&L and reduce the profits.
See, if the management has good intent, that's where this problem will not arise. But of course, that risk always remains. That's why you have this audit
Okay,
requirement also.
okay, sir. Fine. Okay,
And
sir.
that's why you have
Thank
this
you so much,
control
sir.
framework. Okay,
Okay, okay, sir.
sure,
Thank you.
sure.
Sir, it
Yes.
is even for the opposite also it works. So like profit, now they have taken to the profit and loss. They cannot reverse to the capitalization. Suppose they've taken to the capitalization, wanted to go back, they wanted to post it in the profit and loss. Can it be done? Or for that also there is a restriction, sir, from
No,
standard?
there is no such restriction on that. The only problem is that if, let's suppose, they have capitalized that by mistake, okay,
Yes.
and they realize it's a mistake, then they will have to call it as a prior period item, okay, something which is mentioned in the question, which will require separate disclosure in the financial statements, reasoning why that error has taken place. Okay, so that's how company will have to account for and get into the financial reporting.
So
right?
that time I can recognize it as a capital. So sorry, as a expenses. In the
Yeah,
other
of
way.
course. See, if the company says it's an error, then of course they will have to rectify the error.
Okay, sir.
Okay.
Only from profit and loss, I cannot take it to the capital.
Yes.
Okay.
That's not permitted. Right? Okay. Anyone else? Quickly. Anyone else? Any more questions if you have? No? So I think there was one, I think, sort of requirement from you. Maybe you are looking at this question number 11. I am not sure who picked it up, but we can just quickly look at it. So it's a very simple one. Okay, so let's quickly look at it. AB Limited launched a project for producing product X in October X1. It incurred 20 lakhs towards research. Due to the prevailing market conditions, management came to the conclusion product cannot be manufactured and sold in the market for next 10 years. And therefore, the management wants to defer the expenditure, means to write it off over the future years. You are required to advise. I think it's quite straightforward. Tell me, what should be the accounting treatment? Over to you. What is the accounting treatment company should follow? Tell me quickly. What's the accounting treatment? And Lakshmi says, need to take it to expense, goes to P&L. Yes or no? Right? Yeah? Anyone else? Quickly. What do you do in this case? Tell me quickly. I think it's quite straightforward. When it's written, it's in relation to the research phase. So where do you take it? P&L. Do we have any option under the accounting standard to amortize it, to defer it? No. Right? So it's quite straightforward. Where do you take it? It has to go to P&L straight away. You can't defer this. Understood? Clear on this? All right. So now what we can do is we can now move on to the next topic. Okay, and before we move to the next topic, any questions, any doubts if you have? Tell me quickly. Any questions? Any doubts? No? All right. So now let's move on to the next one. AS 28. So this standard is all about impairment. Now, what is the meaning of impairment? See, in a very simple term, you can say it's about the provision. Means if there is any provisioning required, that's what you will assess under this standard. Now let's try to understand the thought process. What do you mean by this provisioning? And what is the meaning of impairment? Okay, so we'll just try to get into the concept first of all, right? Now, let's suppose company has an asset. Say there is a machine. And what is the value? Means what is the carrying amount? Let's suppose its carrying amount is 10 lakhs. Now, if let's suppose company were to generate economic benefits from this asset, right? What are the ways? There are two ways to generate the economic benefits. One, company will use in business. Yes or no? Right? So we can say through business use, company will be generating some cash flows. Correct? Through the business use, company will generate some cash flows. Let's suppose if you use this machine in the business, the economic benefits that you generate, let's suppose that amount happens to be 15 lakhs, right? The other way is to sell. Other way is you sell the asset. Let's suppose if you sell the asset, what do you get? 11 lakhs. Right? In this case, when the company has an asset, what would it expect? It would always expect to generate economic benefits, which is at least 12 lakhs. Sorry, which is at least 10 lakhs. Yes or no? That's the bare minimum expectation company will have. So in this case, whether the company uses this asset in the business or sell this, in both the cases, company will be able to generate the economic benefits equivalent to the amount at which the asset is appearing in the books of accounts. Yes or no? Now, let's suppose if the company use this machine in the business, they will be able to generate 9 lakhs. But if they sell, they will be able to generate 11 lakhs. And let's ignore this value which the company will be able to generate if it is sold. Now, if let's suppose company has a machine appearing in the books at 10 lakhs and company understands that this will be able to generate the economic benefits equivalent to only 9 lakhs. So what does it mean? What does it mean? In a way, it is overstated. It is overstated, yes or no? Why? Because it is going to give the benefits equivalent to 9 lakhs only. Correct? So what should you do? You should create a provision of 1 lakh. Correct? But before you do that, what do you check? That instead of using in the business, if let's suppose I plan to sell this, then you find 11 lakhs. So in this case, will you create a provision? Will you think that creating a provision will be appropriate? Tell me. Akilan says no. Yeah, doesn't make sense. So that means whenever you look at any asset, right? Whenever you look at any asset, and I'm talking about the carrying amount, the amount at which such asset is appearing in the books, what should you do? You should compare that amount with two things. Or you can say with two amounts, always. The value that the asset will generate if used in the business and the value which asset will generate if it is sold. So in this case, what do? Actually, higher of these two amounts you will compute. Yes or no? Higher of these two amounts you will compute, and that you will compare with the carrying amount. Yes or no? Can we say that? That every time what do? You will compute the higher of these two amounts, and whatever you get, that amount you will compare with the carrying amount. Right? Yes or no? Will it be appropriate to say that? Tell me quickly. Will it be right to say that? Yeah. So this is what you talk about consideration for provision in relation to a machine. Now in this case, let me just change the fact pattern. Let's suppose if you sell the machine, you will be able to generate 8 lakhs. In this case, do you think there is any need for creating a provision in respect of the machine? Tell me. Do you think there is a need to create a provision in respect of the machine? In this case, tell me quickly. Great. Dhanlakshmi, Veerashri, they are saying yes. So can you tell me the amount of provision which you will consider in this case? Over to you. Dhanlakshmi says yes. Anil says yes. So can you tell? Right? Because you are considering higher of these two. Yes or no? So higher of these two is 9. So you are saying you will be able to generate 9. So one that you will not be able to generate, let's create a provision for that. Exactly. That's the point. Yes or no? Right? That's the point. Yeah. So this is what you call as impairment. See, the situation in which you will have this requirement to create a provision is known by the terminology impairment. Okay, so that is known by the terminology impairment. So now this is what we will discuss in further detail. What is impairment? Why is this required? And of course, how do you compute this? Right? I think we can now take a break. And after the break, we will continue with our discussion. Sure? So now what we have discussed is that there could be some assets which are having some carrying amount, means which are appearing in the books, which are recorded in the books at some carrying amount. But in terms of the economic benefits which they are expected to generate, you may say it's lower than the amount at which they are appearing in the books, right? This is precisely what we can say the concept of impairment is, right? Or this is what you call as impairment. Now, in this case, the question arises that when do we get into this situation? Okay, so how do we record this? How do we compute this? So that's a secondary thought. We'll get on to that point as well. To begin with, the first question will arise: why would a company, or why would any asset, or why would any sort of this situation arise? Yes or no? So let's try to understand that aspect. See, the standard talks about some indicators for this impairment to be there. Some of the indicators could be internal to the company. Some of the indicators could be external to the company. Means these are arising due to some external environmental factors. Some of them could be due to some of the internal environmental factors. Now, what do you mean by that? So let's try to understand with the help of some examples. Let's suppose there's a significant change in the market. Why? Say there is a technological development. A new technology has come. So the technology which the company was using has changed significantly. If you talk about auto sector, when the BS6 norms were introduced, okay, so some of the infrastructure which the company was having, what do you do with that? What is going to be the economic benefit of that? Will that go for a decline? So let's suppose if we talk about EV now. So what about the existing infrastructure which the companies are using? If let's suppose EV comes in, so that may go for a decline, correct? Similarly, at times there could be some internal factors. Say there is an asset which has got physically damaged. So this was appearing at 40 lakhs, but due to the damage, now what is the value? You may say the value has significantly gone down in terms of the economic benefits you will expect out of it. Okay. So what do you do then? How do you go about it? Correct. So that could be a problem for the company. Right? That could be a problem for the company. Similarly, various other factors may arise. Now, when we talk about these factors, whether these are internal or external, do we have any exhaustive list which we can always go refer and basis which we can decide? Answer is no. See, this is something which is dependent on various things. Objective here is that if there are any such factors which may lead to impairment, the company should assess that. Company should evaluate that. Now, all of these points are what? Judgmental. See, when you talk about a provision, impairment is what? It's nothing but a provision. If let's suppose you create an impairment, or if let's suppose you create a provision, what does it mean? You are creating a provision for impairment, means for a diminution in the value of the asset. So this is always an estimate. Means some sort of judgment is involved therein. right? So that's why you cannot have any exhaustive list which you can just go do a tick and say that yes, it's there and now it's not there. Every time this will require an evaluation on the part of the company. Okay, on the basis of which company will have to decide as to whether there is impairment or not. Clear? Now what we will do is, now we will look at some terms. All of these terms will help us in getting onto the calculations. Okay, so now as a next part, once you understand that there is a need for impairment. Why? Because there are some factors around it. What will you do? You will actually get onto the calculation of impairment. Correct? Now, in this case, let's look at those terms. Let's try to understand all of those terms and try to also get onto that calculation. Okay. Now, before we move on to those terms, those sort of calculations, if you can just confirm if there are any questions so far. Are you clear with this concept so far? Everyone? Any questions, any doubts? Quickly. Any questions? Akila is clear. What about others? Sridhar is also fine. Pawan is good.
Excuse me, sir.
Yes.
Sir, as you specified, like there is no specific list exhaustively specified by the standard to test check whether we need to impair or not.
Right.
Like then, how do we decide based on only these three factors? Like right, whether the asset is getting damaged or not, or like other two conditions, right?
See, what you are trying to do is you are trying to mug up. You are actually trying to find a list which you can just quickly learn and use that. This is not the concept. What is the concept? You need to look into any situation, and on the basis of the situation, you analyze it, whether this can lead to an impairment or not. That is what you call as the concept. Understood? And that's what I've told you, and that's what the standard.
Yeah, sir, I got it. Like
no, but let's try to understand my point. That when you say that these are the only 3 points, that's what my answer is. I cannot say these are the only 3 points or these are the only 30 points. Are you getting it? These are the examples I have given you.
yeah, sir. Basing on the scenario, like basing on the situation, that we'll be able to, like, we are going to decide or judge whether impairment is necessary or not.
No, on the basis of which you
I
will
agree
decide.
with you.
No. So there again, on the basis of these points, you will be getting an understanding that there could be a need for impairment. Okay.
Yeah, sir, I agree with you. But in that case, then like there is no view. Like management might skip or management might fail to catch out when to
see. Why are
like
you worried?
impair and when to do or when
about,
to.
No. So see, every time you have a question, so you are worried that management may not do this, management may not do this. Now, please try to understand what we are discussing here is accounting standards. We are not discussing about the situations wherein the management may not follow that. Why do we have accounting standards? These are the guidances or the principles which the management have to follow. What if the management is not following AS 28? Is it possible? Answer is yes. What if the management is not following AS 26? Is that possible? Answer is yes. Do we need to get into that situation? Do we need to get into that discussion? Is that really relevant for us? Answer is no. That's irrelevant. Please try to understand. There are a lot of things management may not do. Management may not prepare the financial statements on time. Is that possible? Answer is no. So that's why I'm saying, please try to focus on the subject matter. Clear?
Yeah, okay, sir.
Yes. Anyone else?
Thank
Any more
you.
questions? Quickly. Any more questions? No? All right. So now.
Hello, sir.
Once, yes, please.
Yes, sir. In this example, the carrying amount is 10 lakhs and the
Right.
sale value of amount is 8 lakhs.
Right.
So that 2 lakhs is the impairment loss, or the business use and the sale amount, that difference 1 lakh is that is the impairment loss, sir.
We'll discuss that. Okay. So far, we have not gotten to that calculation. So we'll discuss. Right.
But
Now, what is the
the original,
yes?
but the difference is the impairment loss, correct, sir? The original
So
cost
that's
and
what
the
I'm
sale
telling
value.
you, that we have not yet discussed that. I'll move on to that point in some time.
Yes, sir. And also one more doubt. The
Yes.
normal loss of the sale product and the impairment loss, both are same or not, sir?
What do you mean by normal loss of sale product?
Normally, we can buy the product at 10,000 and the sale value of that product is 8,000. So that
Right.
2,000 is normally a loss in the P&L
Yes.
account.
No,
Yes.
but when do you get the loss? Tell me, when do you get the loss?
The sale is lower the amount of the cost.
No, you get the loss when you actually sell the product, isn't it?
Yes, sir.
In this case, we are not talking about sale or the actual sale.
Okay.
Right? We are saying if sold, what is going to be the value? We are not selling the product. We are not selling the asset.
Okay. We assume if we sell.
So we are saying if, let's suppose, you were to sell that today, what is going to be the value? That's the point we are considering here.
Okay. So normal loss of that product and the impairment loss both are different.
Yes.
Correct, sir? Okay.
Yes.
Okay, sir.
Okay.
Yes, sir. Understood.
Sure. Now, what was the first step we discussed? You will look at the factors basis which you will get an indication that impairment could be there. We are not saying impairment on the basis of indicators will always be there. Means you are getting a direction that yes, it's possible. Can we say on the basis of the indicators that the impairment will necessarily be there? Answer is no. So once you have the indicators, what do? You will test whether the impairment is there or not. Okay, so there's a test you will perform. What do you call that test as? Impairment testing. And what do you do in that impairment testing? You compare the carrying amount of the asset with higher of these two amounts. Okay, you compare the carrying amount with higher of these two, 9 and 8. Right? Now, in this case, let's assign some terminology to all of these things. This 10 lakhs, we understand this is called as carrying amount. Yes or no? This 8 lakhs, what will you call it as? Fair value less cost to sell. You can say it's the fair value effectively, right? It's the fair value of the asset. What is this 9 lakhs? This is the value that you get if you use. So that's why you call it as value in use. It's the value that you get if you use. So this is what you call as value in use. And higher of these two means higher of value in use and fair value, what do you call it as? That is what you call as recoverable amount. Recoverable amount means what? Higher of fair value and value in use. So can you tell me in the given example, what will be the recoverable amount? Tell me quickly. In the given example, what will be the recoverable amount? Very good. Vireshri says 9 lakhs. What about others? What about others? What is the recoverable amount? Tell me quickly. Sridhar says it's 9 lakhs. Pawan says it's 9 lakhs. Correct? So in this case, the recoverable amount is 9 lakhs. Okay. So there are few terms we have discussed now. Carrying amount already known to us. Fair value, I think simple to understand. Value in use, we'll discuss how to calculate value in use. And recoverable amount, we have discussed how to calculate recoverable amount. There is a very simple formula. Compute two amounts, value in use, fair value less cost to sell. Higher of these two will be the recoverable amount. Okay, now there is an impairment testing. Now, what do you mean by impairment testing? See, every time, what do we do? Every time we will compare carrying amount and recoverable amount. What do we compare? Carrying amount and recoverable amount. Now, this is very important and I need your attention now. If let's suppose carrying amount is lower than recoverable amount. Let's suppose carrying amount is 8 lakhs. Recoverable amount is 9 lakhs. Do we need to create a provision? Answer is no. That means no impairment is required. Okay. But if let's suppose carrying amount is higher than recoverable amount. Carrying amount is higher than recoverable amount. In such a case, impairment is there. Means impairment exists. And if impairment exists, will you create a provision for impairment? Yes. Yes. So the comparison of carrying amount with the recoverable amount that you do. Okay. So this comparison which you do, this is what you call as impairment testing. You are testing whether impairment exists or not. Once you have the indicator which are giving an indication, what is the next step? Do the impairment testing. If you do the impairment testing, will you always find the impairment? Tell me, if you do the impairment testing, do you think you will always find impairment? Tell me. Answer is no. Impairment may or may not be there. Correct? It depends. Anil is saying depends. Depends on what? Depends on the recoverable amount. Correct? Right? So that's why generally there is a confusion. Whenever we look at any indicator, what do we think? Provision is required. Whenever we talk about impairment, we think provision is required. Whenever we talk about impairment testing, We confuse that with provision for impairment. But please understand, till the time impairment testing doesn't give you the answer that the impairment is required, you will not create a provision for impairment. Understood? Understood, everyone? Now, are you clear on this impairment testing? And how do you create impairment? When do you create impairment? I think somebody asked me, will you be considering higher of these two? What if it is 10 lakh? What if it is 9 lakh? Are you all clear? Everyone? Tell me any questions, any doubts if you have. Everyone clear? See, this is a very important concept and considered to be slightly tricky, or you can say technical at times. So that's why if there are any doubts, please let me know before I move further. Basically, you can say the points that we have discussed so far, it happens to be the crux of the standard. Okay, yeah. So any questions, any doubts if you have, please let me know.
Sir,
Yes.
if the market value is like when you sell the product, sir, when it is more than the book value, then also impairment, we have to create the impairment, sir. Is it compulsory?
You tell me.
Like
On
as
the
per
basis of
whatever
the
you said,
discussion we have had so
based
far.
on the discussion, we have to create the provision.
Okay, so if let's suppose my recoverable amount is 11 lakhs, will you create a provision?
Recoverable amount is 11 lakh. The
Will
carrying
you create
amount
a provision then?
No, I will not create a provision.
You will not create. Okay, but if the recoverable amount is 9 lakhs, will you create a provision?
Yes, I will create.
Yes. Okay. Anil, can you please explain your question?
Sir, like uh, what I mean to say is like certain tests needs to be done by us while applying the standard. Am I correct, sir?
No, there are no certain tests. There is only one test, and that's
One
what you
test.
call
Yeah,
as
that's what.
impairment testing. Okay.
Okay. Okay, sir. Thank you.
Anyone else? Any more questions? No? All right. So now moving further. See, we have discussed about the indicators. We have discussed about the impairment testing. We have also discussed about the impairment. So every time you will have an impairment when the carrying amount is higher than recoverable amount, otherwise not. Okay. If let's suppose recoverable amount is say 11 lakhs. So will you increase the value of the asset? Answer is no. Why? Because we are not talking about revaluation. We are not talking about fair valuation. Why? Let's create it. Okay. Upside will not get into. Right? Will not get into any upside. Right? Now when we talk about this fair value less cost to sell, see, it is very simple. Why? Because you go check the fair value of the asset, which a fair valuer will provide, and straight away you get this. When you talk about value in use, now the question arises, what do you mean by this value in use? And how do you compute that? So what do you mean by value in use? We have already discussed. It means if you use the asset in the business, what is the value you will be able to generate? But how do you get this value in use? So you can say, if let's suppose the asset is used in the business, say the entity plans to use the asset in the business, let's suppose for next 5 years. So in such a case, what are the cash flows which you generate? Okay, let's suppose 2 lakhs in first year, 2 lakhs in second year, 2 lakhs in third year. Let's suppose 3 lakhs in fourth year, 3 lakhs in fifth. And then you will compute the present value of all of these cash flows. So the present value of these cash flows is nothing but the value in use. So if let's suppose we want to compute the value of the asset which you generate through its usage in the business. So what do? You calculate the cash flows which that asset will generate for the company. Compute the present value and that becomes the value in use. Okay. So I'm just trying to help you with the concept around it. We don't need to get into all of these sort of calculations. Okay. So that's the objective. Now, in this case, moving further, let's look at a couple of notes which are important for you. It says, if there is no reason to believe that an asset's value in use materially exceeds its net selling price, the recoverable amount may be taken to be its net selling price. This will often be the case for an asset that is held for disposal. Otherwise, if it is not possible to determine selling price, we take value in use of the asset as its recoverable amount. Okay. Next, recoverable amount is determined for an individual asset unless the asset does not generate cash inflows from the continuing use that are largely independent of those from other assets or a group of assets. In which case, we bring in a concept called as CGU. Okay. Now, some of these terms we have used may appear to be slightly confusing. Okay. So we'll talk about those terms also, this CGU as well. But before that, we can look at these two sort of situations. Quickly, just to summarize. If recoverable amount is more than carrying amount, so we'll ignore it, correct? If the recoverable amount is lower than carrying amount, that's where you will consider this. Now the question arises, if you create this provision, now where do you record it? This goes to P&L. Okay, so this goes to P&L. Now, let's move on to another term that is called as cash generating unit, CGU. It's very commonly called as CGU. Now, what is this CGU? How is it relevant? Let's try to understand that. So first of all, if you look at the definition of CGU, it says CGU is the smallest identifiable group of assets that generate cash inflows from the continuing use that are largely independent of cash inflows from other assets or a group of assets. Okay. Now, For a CGU, I think two things we need to now understand. First of all, that why are we discussing this concept of CGU? And then of course we'll try to maybe do a bit of deep dive into this CGU. Say there is a company, A Limited. It has got 3 plants, P1, P2, P3, 3 plants. What is a cash generating unit? It's the unit of the entity which is capable of generating independent cash flows. So in this case, each of the plant is capable of generating independent cash flows. So therefore, what will you say? This company has got 3 CGUs. CGU1, CGU2, CGU3. Okay, so this company has 3 CGUs. Right? So you can say this is the understanding about CGU, cash generating unit. Okay. Now the question arises, why do we need a CGU at the first place? Now for this, we'll have to go back to our understanding of impairment. For impairment, can you tell me what are the things you'll need? If let's suppose you were to compute impairment, what are the things you'll need? Just think about it quickly. For impairment, what are the things you'll need? Tell me quickly.
The carrying amount, recoverable amount, and value in business.
So when you say recoverable amount, that includes value in use, isn't it?
Yes, yes.
Yes, right? So that means you need a recoverable amount. And for recoverable amount, what do you need? Value in use and fair value less cost to sell. Correct? Now let's talk about this value in use. And the example we discussed, machine. Now practically, let's think about it. I'm just asking you to take a practical approach. Let's suppose there's a company. It has got a plant. In a plant, there are various machines. Do you think that business will be able to identify the cash flows which the machine will be able to generate for the business? Do you think that is practically possible? Answer is no. Why? Because for a business, you may assess the cash flows, which is practically possible. But can you identify the cash flows to each and every machine? That in the plant, machine 1 will generate, say, cash flow 100, machine 2 will generate. No. Why? Because they work collectively. So it's a group of assets which is generating that cash flows. Yes or no? So if you were to identify the cash flows at an individual asset level, that is practically not possible. Yes or no? Right? Now, if let's suppose practically you'll say it's difficult, then how do you compute value in use? Will you be able to do that? Will you be able to do that? Answer is no, you will not be able to do that. So that's why what do you do? That's why what will you do? From this single asset, you will move to group of assets. Why? Because this assessment of impairment is required, no doubt. Standard says do this assessment at an asset level. But at an asset level, it's not possible for you to do that because of the problem we just discussed. So that's why what will you do? You will do this assessment of impairment at a group level. Means you will combine all of these assets and then do the assessment instead of doing it for each and every asset. Okay. So that's where this CGU comes into the picture. Right? Why? Because CGU is what? CGU is nothing but a group of assets. Okay. So what is CGU? Why is it required? I'm hoping you are clear on this now. And what we will try to do is we will try to pick up some more examples in relation to this CGU now. Okay, these small examples we'll try to pick up. Okay, so let's look at this first one. A mining company owns a private railway to support its mining activities. The private railway could be sold only for scrap value, and the private railway does not generate cash flows from continuing use that are largely independent of cash flows from other assets of the mine. In this case, it is not possible to estimate the recoverable amount of private railway because value in use of the private railway cannot be determined and it is probably different from scrap value. Therefore, in this case, entity will estimate the recoverable amount of the CGU to which the private railway belongs, that is by taking the mine as a whole. Means in this case, will you be able to say that the assets of the company other than private railway and the private railway are two different CGUs? Answer is no. Why? Because this private railway is not able to generate, is not capable of generating independent cash flows. Understood? Understood? So this private railway, you will not be able to call it as a CGU. So what do? You club it with other assets. And on a combined basis, you look at it. And you will be thinking, but sir, then this is company, you have only one CGU. Yes, effectively this entire company as a whole becomes the CGU. So it is not necessary for a company to have multiple CGUs. Maybe the company as a whole is considered as one CGU. Right? Next, another example. A bus company provides services under the contract with a municipality that requires minimum service on each of 5 separate routes. So it takes the routes and that's where it requires some of these services. Okay. Assets devoted to each route and the cash flows from each route can be identified separately. One of the routes operates at a significant loss. In this case, since the entity does not have the option to curtail any one bus route, okay, the lowest level of identifiable cash inflows from the continuing use that are largely independent of cash inflows from other assets or the group of assets is what? Is the cash inflows generated by 5 routes together. Correct? Therefore, in this case, what will you say? CGU for each route is what? That's the bus company as a whole. Right? So bus company as a whole becomes the CGU. Clear on this? Everyone, clear on this? What is CGU? Any questions, any doubts around CGU? If you have, please let me know. Yes, quickly. If you have any questions, any doubts around CGU, please let me know. Over to you. Any questions if you have? Tell me quickly. No question? Sure? Yeah, everyone clear?
Sir, can we say like we are testing prudence concept through this standard?
See, we are not testing the prudence concept. We are applying prudence.
Yeah, applying prudence, sorry.
Okay?
Okay, sir.
Yes. Anyone
Okay.
else? Anyone else? Any more questions? Okay, great. Sridhar says we are clear. Very good. So let's quickly try to touch upon some more points. So let's look at this example. A company operates a mine in a country where the legislation requires that the owner must restore the site on completion of its mining operations. Okay. The cost of restoration includes replacement of the overburden, which must be removed before the mining operations commence. A provision for the costs to replace the overburden was recognized as soon as the overburden was removed. The amount provided was recognized as the cost of the mine and is being depreciated over the mine's useful life. The carrying amount of the provision for restoration cost is 50 lakh, which is equivalent to present value of restoration cost. Now this entity is testing the mine for impairment. Now in this case, the CGU for the mine is what? Mine as a whole. The entity has received various offers to buy the mine at a price of around 80 lakhs. This encompasses the fact that the buyer will take over the obligation to restore the overburden. Disposal costs for the mine are negligible. The value in use of the mine is approximately 1.2 crore, excluding restoration cost. The carrying amount of the mine is 1 crore. In this case, what are we trying to do? See, actually, we are trying to get on to all of those concepts and we are trying to compute the amount of impairment, if any. So how do you do that? First, you will need carrying amount. Do we have the carrying amount in the question? Tell me. Do we have the carrying amount? Answer is yes. Yeah, it's given in the question. Now, along with the carrying amount, what is the other thing you will need? Can you tell me? Along with the carrying amount, what is the other thing you will need? Tell me, what is the next step? No, the Lakshmi says value in use. No. Very good. Akhila says recoverable amount. Yes. Along with the carrying amount, what do you need? Recoverable amount. And for this recoverable amount, can you tell me what will you need? For you to compute the recoverable amount, Methili, Virashri, can you tell me what do you need? Tell me, what do you need? Very good. Virashri says fair value and value in use. Correct? So how do you compute recoverable amount? By taking higher of these two amounts. Exactly? Yeah? So this is how you need to every time consider. Because what is recoverable amount? Recoverable amount means higher of fair value less cost to sell and value in use. In this case, now the question arises that some of these values which are given to us, how do you compute value in use? Number one. How do you compute fair value less cost to sell? Okay. Now, before I really get on to the solution, can you help me in computing the amount of value in use and the fair value less cost to sell? Over to you. Quickly. What is fair value less cost to sell? What is value in use in the given example? Yes, everyone. Okay, great. I can see this response from Dhanlakshmi. Dhanlakshmi says it's 1.2 value in use. Maithili has the same answer. Dhanlakshmi says 80 lakhs is the fair value. She is saying 70 lakhs is value in use. Okay. Akila says value in use is 80 lakhs. All right. What about others? Virashri has a different answer. Virashri says value in use 1.2 crore. Fair value is 80 lakhs. Right? So let's look at this. Okay. Now, in this case, net selling price for CGU is 80 lakhs. This amount consider restoration costs that have already been provided for. So therefore, what do? Value in use for CGU is determined after consideration of restoration cost. What is that? 1.2 crore less restoration cost, which is 50 lakhs. Because if let's suppose this asset will generate 1.2 and will require an outflow of 50, so what do you have? 70. So what is the value in use? 70 lakhs. If you look at the carrying amount of the CGU, which is 50 lakhs, which is the carrying amount of the mine, less the carrying amount of the provision for restoration cost. Okay, so in this case, what do? In this case, what do? When you look at the carrying amount, so this carrying amount you will now compare, correct? Yeah. So this carrying amount you will compare, right? So if you compare that, will you create a provision here? Answer is yes. You will create a provision here. Okay. Yeah. Everyone clear on this? Everyone clear? Yeah. So do we need a provision? Answer is yes. We will need a provision. Why? Because our carrying amount is what? 1 crore. And from this carrying amount of the mine, what do we reduce? We reduce this restoration cost. Now, this carrying amount after the restoration cost, what does it become? 50 lakhs. So now when you compare this 50 with the value in use, this comes out to lower. Understood? So that's where, what will you have? That's where you will have this value of 50 to be comparing with the value in use. Why? Because higher of these two you will consider always. Right? Right? Clear? So that's how you will go about it. Clear? Yeah? All right. With this, we are through for today's discussion, but we are not through with this topic. So what we will do is in the next session, we'll continue with this. But it is very important that before we meet next, you revise this. Okay. Yeah. So that you are able to get on to that. And we'll also be looking at some more concepts. We are not through with the concepts also. We'll be looking at some more concepts and more questions. Right. Okay. So thanks everyone. We can
Sir,
just close this. Yes. Yes. Tell me.
the WhatsApp link, please.
Sorry.
WhatsApp link, sir.
WhatsApp. Okay, sure. Yeah. So IT, can you please share this WhatsApp link? Maybe one of the participant is looking at it. So please arrange, and whoever is the concerned person, please ask them to send that to the student. What's your name?
Sir, Nupur.
Nupur. So please, IT, please ask Ajit to share that with Nupur. Right. Okay. It's there in the chat. Okay, Nupur, you can just check that in the chat. Or otherwise, Nupur, you can always feel free to reach out to BOS team also. They will be able to help you on this.
No, sir. Chat में नहीं है.
So that's why I'm saying you can feel free to reach out to BOS team also. They will also be able to help you. Okay.
Okay.
So you can just write to them. They will do that for you. Okay. All right. So thanks everyone. IT, let's close this now. Thank you.